Welcome to a discussion of Federal Milk Marketing Order number 33. This is Dr. Lawrence Jones, and I'm recording this on October 16th, and it is supported by Nobis Agri Science. So I wanted to get started with looking at the statistical uniform prices that you guys just got the other day, because your milk check should be coming out here about any day. So if we look at what we had this month, we're up about $1.31, and the actual statistical uniform price is at $19.38. And I always kind of like to take a look back as to how does that price compare to what we've gotten, like over the last 4 years. And as you can see, we're moving up very significantly. The only time that we've been higher than this is this big run up. And so the question is always, how far are we off of that? And right now we're about $6.40. So right now, milk prices historically look pretty good. They may not feel that way, but again, just looking at the data, they are reasonably good. So you're $1.31 up in statistical uniform prices, and this is how it came together across the country. And so overall, everybody was up about $1.20. The biggest ones are down here in the southeast, which have a nice class one, and we'll talk about that in a minute, $2.28. Whereas if you were very heavily in class three, you're about $1.20. So if we go back and just kind of remind ourselves, where class one is, you guys are at 36% class one. You're very similar to what we have in the Northeast, just kind of 36%. But again, down here in the Southeast, we've got very high class one utilization. Overall, class one utilization was up about 2% for September. And then class three would be the other big one that we always talk about, and you guys are about 46%. Minnesota, Wisconsin is very high at 92%, and again, Northeast is around 30%. So you guys are right in that almost 50% class three. So this is a new graph that I built for you guys. I was trying to figure out how to present this whole concept of depooling, because the way I was doing it before, I just didn't like it. So what I've got here in blue is the daily production of class three. So we look, 2019, we're bopping around about 17 million pounds a day during the pandemic. So all of this blue down here is depooling. You still made, 17 million pounds a day, except it didn't go into the pool. And then we stopped depooling, and now we're up here at 25 million pounds a day. And so that's also an interesting question. What is the difference between this 17 and this 25 million? That's 8 million pounds a day. Well, that's your new cheese plant. So right there, you can see what the new cheese plant impact on Federal Order 33 is. This orange is class 4. So again, during the pandemic, we were never going to depool class 4 because it was very low. So again, we have a capacity about 9 million pounds. You can see that we've been depooling. We kind of quit, and then we're back in it. And then in fact, what we did this month was probably depool a little less. So you're going to see that you guys were up in milk production, and that's partly because we quit depooling that class 4. So if we look forward here, this is what class 3 and class 4 futures look like. And so these are very far apart for October, and they're going to narrow up, come basically the new year. And that brings me to another important point, because a lot of dairymen are being asked, what is their opinion of the class 1 mover? And again, you guys probably don't have enough data to talk about. During the pandemic, the higher of was clearly better, but we're not in a pandemic anymore. But during October and November, and even into December, the higher of is going to be a better deal for you. And again, we're talking about 25% of the milk because it's the class 1 mover. But once we get into this new year, the average plus 74 is better. So I fall in the camp. I think we ought to keep it as the average plus 74. It just allows us to kind of look at the data a little bit easier and forecast and some of those sorts of things. But anyway, that's my 2 cents on that. Fat percentage was just kind of very, very good. So across the country, we're at 404 in the federal orders. You guys are in 401. Look at the 422 in the Northwest and 383 in the Southeast, but just very good. And we look at your numbers, 401, but a year ago you were 394. So we've increased another 600 in fat test. And so this has just been going up year after year. And if we look at the country, this is as of August because we don't have the September egg prices where we get the fat percentage for the country. But again, we're growing the fat percentage at 1.1%. So this is just constantly going up. We were clear down here at 3.6 and now we're, pushing 4 and change out here in 2023. Protein, you were at 318. Not all the orders have protein reported. And again, you're 318 and same thing last year. So protein has not changed as much and it's been fairly flat. And that's partly due to price. I mean, October protein prices are looking like they could be $1 off, what we would hope them to be closer to $3. So feeding for protein right now just doesn't seem to be overly profitable. So last month I did give you some things that I was doing about different hedging options, and I told you I was selling those $19 calls for 50 cents in December. So let's go look at December. So those would have been up here for 50 cents. Right now we're down here. So that looked like a pretty good decision. And if we look at this December contract, I pulled this off of QST just a few minutes ago. So it's 1762. And so this is not pushing 19 very hard at all. So we've come way off of those numbers and come down almost $1 here in September. So what am I doing now? So this last week we were selling these January 1875 calls for 50 cents. If we look at January, that's pushing a little bit pressure there because we're at 18. We're selling 1875. So we're up here somewhere and we're going to get 50 cents for them. But look at this premium that January has relative to the spot market. So there's a very high probability that these contracts are probably going to come down. The spot market might come up a little bit, but these always match at the end of the day. And I'll be doing a presentation next week for Nobis up in the thumb, and one of the things we're going to talk about is how to actually estimate milk prices in the future. Because one of the things that has become very clear to me, if you ask a dairyman what milk prices are going to be, they're always going to be good. And they have a very strong tendency to overestimate milk prices and are overly optimistic. And I can go through the data as to why that is. And again, if you take these October contract, we're just getting ready to settle this up here in the next 3 weeks. We could have sold all our milk at $19, and now we're going to end up, probably $16.60 plus or minus a few cents. This graph down here is one that I kind of put together for my weekly podcast, which I want to see when October goes into what I call glide path mode, and that's when it has less than a 10-cent move in a particular day, and when this gets close to closing, it'll just be basically no movement. And so we're kind of predicting this to be around 1660 with a class 4 around 22. The other thing I like to look at in the federal milk marketing data we just got is change in daily production. And so overall it was up 5% for the country, but again, that's not real. If you look at this 110, 114, 109, 113, and even year 113, that's because they quit depooling class 4. The Northeast is very short on milk right now, but that's because milk is flowing to the south, and I think also out of Washington they're short on milk because milk was flowing south a little bit. But overall, I think September milk is going to be flat with August, is how I have it put together. Big question. I've been going back and forth with numerous people today on what are actual cow numbers, because we're going to get a milk production report here on Wednesday. And the slaughter data for end of September is again quite low at 56,500. Now, one of the things I did learn about this is we do slaughter some Canadian cattle, so if anything, this is biased up. But I don't necessarily like to look at those numbers. I like to look at it relative to the size of the herd. And so if you do that, we have a slaughter rate, in this 32 to 34% band right here. And to me, that suggests that cow numbers should be fairly stable. StoneX right now is just got the numbers from them, and they think cow numbers are going to drop by about 7,000 cows this next week. And I'm not quite there. I think they're going to be stable. But again, I've been arguing we're 9.4 plus or minus, 10, and that's what this red box is for almost 2 years. Yes, we were down a little bit here. Yes, we were up a little bit here. But we're really in this 9.4 plus or minus a little bit. And if you go back to 2015, maybe we were stable, in here, but there's very few times we've been pretty much as stable as we have been now. We did get a global dairy trade 2 weeks ago, and so we actually have one tomorrow, but this has been up 3 sessions over sessions, and part of that is being driven by whole milk powder and skim milk powder, which is a proxy for non-fat dry milk. But overall, we can't compete in the world market. These are spot market numbers as of a week ago, so they're a little bit lower now, particularly for butter. But when you've got these kind of world prices, it takes about 20 cents for us to get product offshore, and we're not participating. In fact, the cheese exports last month was only about 6.5% or something, very, very small. Now, this is a new graph that I also put together. I don't think I've shown this to you before. So what this is the blue line is basically the spot market, and the orange line is the actual National Dairy Sales Report. And I show you this simply to tell you that the spot market is a very good predictor of what is going to happen to milk prices. If you see the spot market beginning to move, then prices are going to move with it. And again, you look back, I've got it through 2011, that's a very high correlation. Now, there are times when they're different. That's not exact, but it's a pretty good predictor. So with that being said, let's look at what's going on with the spot market. So here's our cheese spot market with trends built into it. So this run up back here in March was all Schreiber and Olam buying cheese. This run down here was all AgriPure selling cheese. And we had this crazy run up here of, basically 4 days of where we just jumped up in cheese prices, and then we settled out. Now we've come down, and I would suggest that we're going to settle out about where we are now for a little bit. I think the steam is running out of this spot market for cheese, and in fact today it was basically a flat spot market. Now, part of what's going on with cheese is we've got very high stocks. We've come in at about 1.5 billion pounds. We've been growing stocks at 3% per year. So I am very bearish on cheese at this point, because if we were significantly lower in stocks, I would say yes, let's be bullish on cheese. And we've got almost 39 days of excess cheese in cold storage at this point. The other number that I've started calculating when we get the dairy products report is where are we at today versus our maximum production. And right now it would suggest that these cheese plants are running about 94% of capacity. And that's just based on the highest production we've ever had out of them. So there's a lot of excess cheese capacity right now. A couple things to comment on this is most people don't realize that Italian type cheeses are the largest percentage of cheese that are made. They're about 43%. That's been declining over time, such as your mozzarella's and some of those sorts of things. American, which includes cheddar, is about 40%, and that's been increasing. And when that increases, that puts more cheese onto the spot market, which is going to drive down prices a little bit. So again, we've got two things going on here. Whey is going to be one of those that just kind of stair steps up on you, and it's slowly coming up. It's increased from 28 to 34 cents. But the reason I wanted to put this in is historically, whey doesn't trade on the spot market 0-1. But if we look at last Friday, there's 18, 20, 21 trades. There's just a huge amount of whey being traded. which tells me there's got to be a huge amount of cheese being made to make that whey. Butter prices, again, you probably heard they hit some all-time highs, and they've come off of that. But again, we're still about 336 or so, and so we're way above the global dairy trade at 212. And so the question is, what's going on with butter? Why is that so high? Well, I think there's several things going on. So this is the butter stocks, which are very cyclical. The red dots are, previous August numbers. And I think we're in a new paradigm. If we go back and actually plot out where we were this August, last August, ignore the pandemic and the year after it, to me, I think we have a very clear trend that stocks are not being represented by what we had 2 years ago. And so we've really come down on these butter stocks, which has basically made butter short at this point. And the other thing that is catching a few people by surprise, this is the cottage cheese production. Now, it's been declining over time. You can see that red line down, but look at the last few months. Just off the chart high. And I'm hearing that cottage cheese is just taking off. There's a plant in New York that's being expanded just so they can meet the cottage cheese demand, but that is just off the chart high. And so we have to keep an eye on cottage cheese. Now, we don't get priced off cottage cheese, but it does pull milk away from other typical uses, and so we might see a little bit less butter made or a little bit less cheese made to make this cottage cheese. Non-fat dry milk is very dependent upon the global prices, and so we're going to have a global dairy trade on Tuesday to give us a little bit more evidence, but right now this is starting to just level out here, just kind of waiting for some guidance from the international market. And I think today it closed unchanged just because they need some guidance. Normally, we're going to run 20 cents. So the blue line is the global dairy trade. The black dots are the spot market. And this is a 20-cent range here. And so normally, non-fat dry milk would be down here, but it's holding up top end of that range at this point. So the other big part of profitability on dairy is going to be the grains, and so I always like to spend a second on those. And of course, we had the WASDE report last week that kind of changed everything up a little bit. But corn is without basis for the next 12 months is running about $183. Soybean meal around $381. And just as a guide, I like to take 8 pounds of corn, 8 pounds of soybean meal, and say, well, how much does it cost to feed a cow a day? And that's $2.26. That's one of the lowest numbers that we've had for a while. That number's been as high as 250, 260, 270, so that's significantly down. And so I always put these in the year-long channel, so we're looking at the next 12 months. We've got 175 as support for corn and a resistance up here at 230. And this has been kind of trending up just a little bit, particularly with that WASDE report. It seemed to gain a little bit of legs to it. Soybean meal, I've got really around 370 up to about 420. And it's also kind of turning up in this trend a little bit. And the other thing that we did talk about last time was these 2024 corn calls, because if you buy a call, all you risk is the premium. So I bought some $6 calls at 15 cents here, and so they have been coming up a little bit. And there's a lot of speculation that next summer could be very dry, and we could have expensive corn. So one of the ways that you hedge against that is to buy those corn calls. And at this point, they were fairly cheap, and they've turned up nicely. So our 50-50 milk blend is trending up, and we're kind of pushing this 19 number. And kind of my assessment of this is back in January we were right at 19, and so that I think is kind of our resistance number. We're not going to see this 21 that we saw about a year ago, but I think 19 is about where we're going to be. And our dairy margin, which is that 50-50 blend minus that $2.26 corn and soybean energy complex. So we're at about $13. Now I know that's not income over feed cost. I know that's not profitability, but that just gives us a sense of where that has been. And I think, again, that was clear at 14 when we had higher milk prices, but at 13 seems to be about where we are now. All right, so I'm not going to spend much time on weather other than say this whole issue of the Mississippi River is just a big deal. Right now, we're about 11 and a half feet below normal. This is creating significant havoc to get barges down the Mississippi River, and so that's going to impact basis basically in the Midwest. It's going to be a lot more to get grain out. Barges are only able to carry 50 or 60% of normal, and some are hitting ground and breaking up, and it's just a kind of a big mess. All right, so that kind of gives you a sense of what's going on here. And some of you I'll see next week up in the Thumb, and I appreciate Ben inviting me up to that meeting. And then for everybody, I'll get you another report next month.